Now, let's think about how to introduce your business to prospective investors or to any concerned parties. So this introduction of business is sometimes called introduction of a speech, because it's kind of brief introduction of your business impromptu. So anytime, for instance, you have run into some very important prospective investors in the elevator, how to get his interest in just a couple of minutes regarding your business. So that's why it's called introduction of a speech. So it's a very brief description of nature of your business, your opportunity, your product idea, and then your qualification, as well as market situation. So when you prepare the introduction of your business, I'd like to advise you, imagine, so you explain your business idea on the street to the potential investors. So let's think about steps of introducing your business. The first step, as you describe the opportunity or problem that need to be solved. So what's the attractiveness of your business? What your business can contribute to resolve some current problems at the market or in your area of business. And the next step, as you describe how your product or service meet such an opportunity or solve the concerned problems. That means you can give some idea how your product or service achieve to satisfy the opportunity or problem solving in concerned area. And third step, as describe your qualification and show how you have such capacity to carry your business to meet concerned opportunities. And then fourth step, as you can describe your market. What's the market potential? How much it will grow? How much you can capitalize at the market opportunity in your business area? So for example, these are five key questions that investors are very likely to ask when you seek their investment. The first one is, how much money you need? So you are supposed to tell them what's the exact amount you need. So you shouldn't be vague in describing your money. For instance, don't say as much as possible, because in case you are not clear in giving them idea of size of the fund you need, they would be convinced that you are credible to handle their money for your business. And the second question is, what do you plan to use it for? You need to explain to prospective investors what you are going to use their money for. And third question is, how will this money improve the business? So once you give them a clear idea about the size of money and then where you put their monies in, and then you need to show them how their money will be put up, will be invested to improve your business. So that means you have to provide actual projection of how your business will be different after their money is injected in your business. So my business will grow this much after injection of your money, kind of thing. And then fourth, how are you going to pay back or provide a return on the money? So you have to demonstrate cash flow projection. That means it's their money. So they are extremely concerned that the safety of their investment and then assurance their investment will be paid back with a substantial return as promised. So it's very important to demonstrate cash flow projection to assure them safety and profitability of their investment. The last question is, do you have an alternative plan just in case of critical problems arising out of your business? That means even though we are very careful in preparing for our business from the planning stage to implementation stage, but there must be some uncertainties that your business may not go as you expected. So you need to have a plan what to do in such a case by showing contingency plan to your prospective investors. So it's always, even though you are very confident in the future of your business, you need to prepare a contingency plan to give the assurance to your prospective investors. But now, let's think about the financial planning. Financial planning is essential to running a successful business. Once you have your business plan and you get your financial resources, and next stage is to run your business by injecting your financial resources all the concerned area as you planned. And then next, you have to figure out how your business will go with such the funds be invested. So financial planning should be different based on whether it's short term or it's long term. In short term, your business should meet the break-even point. That means you have to get out of your unprofitable stage into profit-generating stage as quickly as possible. That's the short-term goal of your financial plan. Long-term, you should pursue the initial public offering. So that means not only you generate sufficient profit and cash flow, you should also prepare for all investors as well as other stakeholders, including employees, to share the benefit of growth and success of your business through initial public offering. So first, let's think about short-term financial planning. The break-even point is level of operation at which a business neither earns a profit nor incurs a loss. So that means at the break-even point, before you reach break-even point, you suffer loss. But after you pass the break-even point, you are generating profit. So break-even point is kind of the level of your business, that your business is a chain turnaround from initial stage that may not generate profit to the more stable stage of generating positive net cash flows. So financial planning and short term, that means break-even point, is useful planning tool in short term because it shows entrepreneurs minimum level of activity that would be required to stay in business. That means unless you pass break-even point, so you may not stay in business continually. So it's critical. So you pass the break-even point as quickly as possible. That must be the first primary goal of your business in short term. So with one change in the break-even calculation, an entrepreneur can also figure out the sales volume that would be required to reach a particular profit target. So through break-even analysis, you would get an idea of the level of your business, that minimum level of business that will give you a profitable business, but also you can get an idea how you can reach particular target profit. So you can understand how much you should develop your business to get the particular target profit in your business. So let's briefly think about how to calculate break-even point. The first step is you should determine the expenses your business can expect to incur. And then next step, you can categorize the business in step 1 into fixed portion and variable portion of expenses. And then next, you can calculate the ratio of variable expenses to net sales. And then calculate the contribution margin. So contribution margin is 1 minus variable expenses over your net sales estimated. So once you calculate contribution margin, and then you can compute break-even point. Break-even point is total fixed cost divided by contribution margin. So this is the graph that shows how break-even point is constructed. In your business, this green line shows your total revenue, because total revenue is increased as the sales volume increase. So the growth of your total revenue is straight line, because growth revenue can be calculated your sales volume multiplied by unit price. So this is unit price times sales volume. So this must be straight line. But what about your cost? As you know, cost can be classified into fixed portion and variable portion. So even though you don't produce any item, but once you start your business, you incurred already the fixed expenses. So no matter how much you produce, so there must be some expenses that you have to incur, that fixed portion. And then there are another type of expenses that vary according to the size of production. So total cost is summation of total fixed cost plus total variable cost. Total variable cost is unit cost times total production. So this red line represents total cost. So your profit is total revenue minus total cost. So this difference is profit area. So this green line is total cost, and green line is total profit, red line is total cost. So this difference is profit. But in this stage, so your production or your sales don't reach to break-even point, your total revenue is less than total cost because of portion of total fixed cost. So in this stage, total revenue is less than total cost. That means you may not produce profitable business. So as your sales volume as well as production size increase, you finally reach break-even point. At this break-even point, your total cost is the same as total revenue. So once you pass this break-even point, and then your total revenue is greater than total cost, and then your business begins to produce profitable business. So this break-even chart shows relationship between size of your business and then the nature of profit of your business. So let's give you some example. The Magic Shop net sales estimate is $950,000. Its cost of goods sold is $646,000. Total expenses $236,500. Variable expenses is $705,125, and fixed expenses $375,000. So with these data, so we can calculate contribution margin just as I showed in the previous slide. So in this case, break-even point sales volume is 682,212. So unless you reach your sales volume of this much, your business suffers loss. But from this volume of business, so sales volume of 682,000, your business begins to generate profit. So in short-term goal of your business is to reach this stage and this level of sales and production as quickly as possible. Now, let's think about long-term financial planning. As its initial public offering. On initial public offering, as company's first sale of stock to the public. When a company goes public, its stock is traded on one of the major stock exchanges. Most entrepreneurial firms that go public in the United States trade on the NASDAQ, which is weighted heavily toward technology, biotech, and small company stocks. An IPO is an important milestone for a firm. Typically, a firm is not able to go public until it has demonstrated the business is viable and has a bright future. So there are 4 reasons that motivate firms to go public. The first thing is IPO is a way to raise equity capital to fund current and future operation. An IPO raises a firm's public profile that would make it easier to attract high quality customers, alliance partners, and employees. And third reason, an IPO is liquidity event. That means it provides a means for the company shareholders as well as its investors to cash out their investment. The fourth reason is by going public, the company could create another form of currency that can be used to grow the company. For instance, let's think about Google's. So Google was founded by Larry Page and Sergey Brin. They met in 1995 when they were doctoral students in computer science at Stanford. They launched Google in September in 1998 in a friend's garage in California. And Google generated 85% of its revenue from advertising. This is Google's income statement, but in 1999 it suffers loss, same loss in 2000, but from 2001 they started to generate profit, but the growth of profit is enormous. So that's what the entrepreneurial business, startup company looks like, from initial stage of suffering loss to the growing stage of generating substantial profitable business. So in July 26 in 2004, Google filed IPO with the SEC. So they seek to raise $2.7 billion by selling 24,600,000 shares. It's about 9% of total shares in total revenue is almost $2 billion. So after IPO, so more capital was available to Google for future investment. So that's the moment to provide the huge opportunities for Google to future growth, as you observed for the last 10 years. And then second consequence is rich employees. So after IPO, once a person has the sense of the wealth, the commitment to the company and where it's going can fall off. So all employees could be made better off after IPO, and they are quite happy now. And workforce motivation. So about 1,000 employees became millionaires after IPO.